You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to another episode of The Builder's Mindset. It's a double dose of earnings. So Lennar recently reported their Q1 earnings. In my opinion, they kind of lead the quarter. It's a couple others are off. Lennar ends their year November 30th, so they do their Q1 ends the end of February, so they're the first ones to report from a Q1 perspective, except, caveat, not really, Toll and Cahob actually closed their year October 31st. So they actually report their Q1 ends the end of January. However, from an overall analysis standpoint, just my opinion, I am no expert, just a 20-year home building operations and supply chain junkie who loves the stock market and loves watching how certain metrics perform. I believe because of the cyclicality the seasonality of the home building industry, that Lennar's Q1 of December, January, February is more indicative of the rest of the market than Toll and Cahob's Q1, that is November, December, January. I feel Toll and Cahob's Q1 is more on the lines of the Q4 of the other builders. But it really doesn't work out that way in terms of the numbers because they call it their Q1 because they close their year end the 10/31. But we'll talk about it a little bit because their Q1 numbers, as they call them, are out, and I don't want to confuse anybody. And in our report last week, we did the overall summary for all the public home builders. That's out now. If you haven't got your copy, just click the link in the show notes. Sign up for the email list. We try not to spam it. You get one email a week. It's kind of what's up in home building. You get the latest and greatest of all the drops of things. Like every time our quarterly earnings report comes out, the summary comes out, you get it. But last week we kind of covered high level overview. We looked at just how everybody reported. And I wanted to do a special this week, really because Lennar comes out. And I think it's kind of like, if you ever heard the saying, so goes California, so goes the nation. That's probably going to change. We'll see how things go here in the future. But historically speaking, like a good example is the car emission standards are so stringent in California, and the California market is so large that there are certain things, I think for a time, like auto manufacturers have to decide if California does things a certain way or they create like certain emissions rules or environmental rules, companies really have to think about like just doing that nationally because it's such a large, I think California is the 7th or the 8th largest economy in the world ranked as a country. So I like to say, so goes Lennar, so goes the home building industry. And I think that's generally because of how large and aggressive they are with their strategy, both pricing wise and operationally wise, but also they're a month ahead. So their Q1 comes out a month ahead of everybody. They close their year a month ahead of everybody. And I take that back. So does KB. But I don't believe KB's next week from when I'm recording this anyway. So we'll have to see if we do a follow-up and do one for KB, which maybe we will, because that'll kind of be interesting. So we'll do another in a couple of weeks. We'll do a KB one, and we'll talk, just kind of, we'll look at KB's in particular and kind of analyze their Q1, which is right in line with Lennar, and so that'll kind of a little telling. Except the unique thing is that KB and Lennar have completely different sort of business strategies in my opinion, and some of it's rooted in what they do is, Lennar, everything's included, everything's about spec homes, production volume pace, whereas KB, they have their BTO or their build to order. They build their model a little bit more around what the home builder wants and choice and selection. So that'll be interesting. So what we'll do is this week we're going to talk about Lennar, and probably in 2 weeks we'll come back and we'll talk about KB, and I'll do a little bit of a cross-reference between the two to see if one of them fared any better or not as good as the other one, considering that they do have different go-to-market strategies. So that'll be interesting. So really high level, and I'll cover KHOV and Toll really quickly at the front end as it relates to Lennar, just from the standpoint that as I look at some of the data sets here, what we've got is, if you look at KHOV and Toll and Lennar, average selling price of the home is down for all of them. KHOV, year over year, average selling price is down 4.4%. Toll, down 7.7%. Lennar, surprisingly though, down only 1%. So interesting. They're holding their average base sales price pretty steady, but still down. And I think we're going to see that with everybody. So the other thing that I mentioned last week, or in the last one, we talked about the overall earnings for the Q4, backlog. So again, backlog is down. So, backlog is the number of homes that these home builders have sold, but not, they haven't closed yet. So they're orders that are going to come to pass. So KHOV order backlog down 16.1%. These are year over year. So these are not seasonally, in a sense. Like, these are more like kind of cyclical data because they're looking year to year. It's not previous quarter. Down 16.1%. Toll backlog is down 6% in units, 2% in value. And Lennar backlog is down 19% in total number of homes, 22% in value. Now, their backlog could be down a little bit as last quarter. So what was their Q4? Lennar missed sales by a good chunk, and they may be still trying to catch back up as it relates to that. So I'm the optimist. I say it all the time. I want to wait till Q2 Lennar numbers before I see if those don't start to come a little bit back in check with how Lennar and the machine works. So so what else? We have, gross margins. Yeah. Gross margins are down, right? Where builders are giving incentives to sell homes, whether it's mortgage rate buy downs or if it's discounted options. They're trying to maintain their base house price. In some instances, Lennar did a really good job of that, but it's looking more along the lines though that 7.7 average sales price. Toll dropping their price a little bit, and that's impacting their home gross margin. So we'll start with KHOV. Gross margin was down 3.1% to 15.2. Toll gross margin was down 2.6 to 25. Once again, you got to go get a copy of the full report that we sent out, because you really get to see the range of gross margin from builder to builder. It is like that. So KHOV at 15.2%, Toll at 25%. There's a big spread between those. All right. So, but both down, and Lennar margins down. Their gross margins were down 3.1% to 18.7, lower than Toll, higher than KHOV. But that's just a fact of getting aggressive with their incentives, which I believe they reported their incentives was 13% of sale price. If I can find that here. Okay. Yeah, incentives at 13% are suppressing margins. So that's kind of hitting them pretty hard. So that's where we're at there. Those are the three big ones. So our average selling price is coming down. Our order backlog is coming down. That's the one I'm going to be watching quarter to quarter, because to me that's the one that's really the concerning one, which may or may not cause me to lose the bets that I have in terms of what I feel like 2025 is going to be for closings and gross margins. So average selling price down, order backlog down in both number value, and gross margin is down. Now we're going to jump in and really just kind of dig deep into Lennar and Lennar's reporting data. If you haven't listened to the call, I highly recommend you do. I believe Lennar's pretty good about posting the recording of their transcript. They're pretty, it's up pretty quick. I highly recommend. It's an hour. I think it was maybe a little bit more than an hour. Go listen to it. It's really insightful. I encourage all of you every time we have this time of season. So 4 times a year, I'm always telling all of you, go listen to a builder. Try to listen to 2 if you can. You're not going to be able to listen to all of them, unless you've got 20 free hours a quarter of free time. But if you do 2 and you mix it up, one quarter you do, number 1 and number 3. The next quarter you do 2 and 4. You kind of work your way around, or maybe you do 1 and 20. Kind of do like the brackets. You do number 1, number 20, number 2, and number 19. Mix it up, but you get a different perspective at least each quarter of the 2. So, Lennar revenue. So, let's see. Should we stay? What do we want? We want the good news or the bad news first? So we already gave you 3 of the bad news. So, right, we said that average selling price was down by 1%. I don't know that I call that bad news, but I think a lot of people would. Wall Street would. I think controlling your average selling price, and if you've looked at what builders like Meritage has done over, say, their trend over 4 or 5 years, they've just continually been able to either hold it or pull it down some as they've shifted their strategy to more entry-level builders. So that we talked about that. Gross margin, we said that's down for Lennar, again, down 3.1% to 18.7%. And we talked about backlog. Their backlog was down 19% in terms of units and 22% in value. Let's just roll out all the negatives so we can finish on the positive because, once again, the optimist. I like to focus on what is good. So we'll finish with good stuff. So let's wrap up. So on the downside, their earnings per share was down 24% to 1.96 from 2.57. They had a significant investment in tech. They're working on a new data platform, is my understanding, to really get their machine and their data-driven model up as an investment in the future. And so when they adjust that out to look at it, then their earnings per share was 2.14. $2.14, but still down from $2.57 a year ago. So there was another thing that Wall Street didn't like. We'll talk about what Wall Street does when they don't like what you're doing. SG&A, we've talked about the selling, general and administrative expenses, 8.5% of home builder revenue. That was up 0.3% from 8.2%. 30 bips for those of you accounting folks who like to hear the bips thing. I don't know. I'm good with the bips when it's less than 1%, but when the bips get over and it's like 310%, then I just like to say 3.1. So I just kind of focus on that. So SG&A is up. They talked a little bit again about their tech investments impacting that SG&A slightly increase. But I think that I still, we talked about that. I think if your SG&A is below 10%, I think you're in a good place. And, it's at 8.5%, not horrible, but it was up a little bit, okay? And then net margins, their net margins is where they really took the big ding, 10.2%. Down from 12.6. We've talked about this one as too. Being over 12% is really where builders want to be. Builders carry a lot of liability. It doesn't matter what state you're in. You carry a ton of liability for these homes structurally and or even the short-term and long-term warranties. It's very difficult. And you've got to generate, you got to keep generating a significant amount of capital to put into future investments for land. And you've also got to, generate that to be able to make it make sense to invest in that future land. You've got to have that promise of that future. So, but they took a big hit there. And then home builder debt to capital went up a little bit from 8.6 to 8.9. That's not really my bailiwick. We like to focus on the operational supply chain, cycle time type stuff, but marginal, but it's on there. So now though, let's go and focus on all of the positive. Then we'll talk about what the stock market did. So We'll just run it down. So they control 98% of their lots, highest ever, but they own only 0.2% or 0.2 years supply. It's their lowest ever. Right in line with their land light strategy that they've been talking about for quite some time. Finished the spinoff of Millrose. So I would say those two items right there are true to what they've been saying. So in that area, you could say they're meeting the expectations that they've been set. Unsold completed homes per community, about 2. I think that's phenomenal in today's day and age in this market. We hear all this talk about a glut of inventory oversupply. I'm not buying it. I don't think it's there. I don't think it's an issue. And so I think 2 per community completed homes, not bad at all. Cycle time. Here's the big one. Cycle time is down 11% year over year from 154 calendar days to 137 calendar days. They are just killing it. That's 4.5 months basically. They're just doing a phenomenal job there, and that is leading right into their improved inventory turn of 1.7x where it was 1.5. So they continue to drive efficiencies in their building process, and they're doing a great job. So okay, so we got 3 other things. We're gonna roll into what the stock market did with all of that. So their new orders, these are sales, were up 1% year over year. Not huge, but at least it's still up to 18,355 houses. But I did forget to mention there, the value of that, but we kind of talked about it in the backlog. The value of those new order sales was down 4% year over year, which contributed to the backlog. But new order sales up. Up is good. Positive is good year over year. So we've been having great years, and so to have another year where it's, even if it's slightly up, that's positive in my opinion. In my book, home deliveries. This is closings. Up 6% to 17,834. We're going to do a summary of closings year over year, but Lennar, in my opinion, continues to gain ground on Horton. I don't think they're taking their foot off of the gas, and they continue to show that with new orders being up year over year, and home 1%, and home deliveries up 6% year over year. And then we'll finish off, cap it off. Their revenue year over year, $7.63 billion, was up about 4% year over year. So that's Lennar's earnings report in a nutshell. They talked a lot about flexibility and nimbleness. They were asked by some of the analysts, could they scale, up or down their production quickly based on market changes? I think they showed that. They did admit in the last earnings report, not this most recent one, but for Q4, that they didn't react fast enough to the changing market demands and pricing down to the community level. But I believe they're getting better about implementing that, and they're not going to let that happen again. They said they can scale that production and or use, I think they use a new term. They said they've historically called their margin a shock absorber. I forget the term they use this time, but essentially they've got different levers that they can move to, ultimately their goal is to match their production and sales pace. And old school days, some people would think, oh, well, that just means you'll slow up your sales pace if sales get slower. Not so much. And this will go back to, so goes Lennar, so goes the competitors, because as I've watched them over the past few years, sometimes Lennar's decision is to just boost incentives, hold on a base price or lower base price to keep the sales pace. They'll come and meet that affordability index because they choose to continue to meet the sales pace because they want to get their production numbers and they want to get their deliveries and closing numbers. They can do that, or yes, they can slow up starts. Lennar typically doesn't do that. There's other larger builders who that's kind of more their MO. And then I would say typically your BTOs, we talked about KB, and we'll do something in a couple weeks on their report because those will be next out. If you're a build to order, then it gets a little trickier there because you're typically waiting for buyers. And so you're almost tying yourself to your sales pace. You can, yes, adjust pricing, just like we talked about Lennar can do to keep the sales pace going. However, Lennar's commitment to starting homes, I think, keeps both the sales pace and the production pace always kind of moving with the inertia it has. They can slow up a little bit, they can ease up. I feel like the build to order builders typically are a little bit more tied to the overall demand, and if they adjust sales pricing, they then have to wait for the response to that sales pricing to keep the production going. And that can cause a whole host of problems for builders market by market. If those are significant, it's kind of hard if you're saying, hey, I'm going to start 5 homes a month, and then next month I'm going to start 3, and then the following month I'm going to start 7. In California, it gets really wonky. Southern Cal in particular, they still do phase building where they'll start 4 to 10 homes at a time, and sometimes that'll slow up one of those phase starts by a week or two. You can miss crew availability in the field. It creates a whole host of things. So big advocate of the spec thing from a production perspective. I mean, liken it to this. It's like if you're building cars, where you don't even have the weather to contend with because you're in a factory, think about adjusting the speed of the assembly line every couple of weeks. So that, this week, I think there's a thing once that said, like at one point in time when the Ford Mustang was like at its peak, every 6 minutes, they said, a Ford Mustang came off the assembly line. Well, imagine if 1 week that was 6 minutes, and then the next month it was 9, and then the next month it was 5. You can't get a flow from that perspective. So, they talked about, they can scale, and they said it could take, a quarter or two to kind of get those back in balance from a numbers perspective. So, then they also talked about strong trade relationships helping to contain labor cost risk and mitigate tariff immigration concerns. We've got a great podcast coming up, probably, I think it'll be the next week or so, where we're going to talk about what I'm referring to as the price increase clashing with price reduction requests. So more on that, but essentially builders with these margin compressions are going to want prices to come down, but material prices are not really moving. Labor prices aren't really moving, but they might have to. And a lot of trade partners are feeling the need to go and ask for increases while builders are sending out letters and requests for decreases. It's going to be an interesting dynamic, in my opinion, for Q2 as it relates to just overall pricing strategy and negotiating and purchasing strategy from both sides, on the trade partner side and on the builder side. Be really interesting to see how things play out. We're going to talk a little bit about it in another episode, and then we'll probably follow up as we get to the beginning of Q3, just to sort of see how it pans out. And my good friend and just amazing sales expert and leadership trainer, sales leadership and sales operations trainer, Michelle Skeldon, and I, on April the 16th, just a few weeks from now, about 3.5 weeks, I think, we're doing a webinar together where we're going to talk about those two things and share with some of the trade partners who, folks you can sign up for it now. We'll put the link for that in the show notes if you're interested too. It's specifically for trade partners. We're giving them tips, tools, and tactics on how to approach your price increase request, how to prepare for them, how to add value to your customers, your builder customers, so that it's really met as more of a partnership aspect as opposed to a clash, which is what I'm going to talk about next week in my upcoming podcast. So that's where we're at, in terms of the earnings season has begun for Q1, and like I said, we're still seeing deliveries up, revenues up, new orders up, cycle times down. Albeit on all those ones that are up, they are slowing. They're not as up as they were a year ago, 2 years ago. And then as we talked about, it's getting to be competitive out there. Interest rates are staying high. Home prices are still elevated. All kinds of, everybody wants to get scared and nervous and freak out over the T word. And, it's impacting gross margins. It's impacting SG&A. And it's impacting net earnings, net margins, and backlog. And the backlog is the one, like I said, I've gone on record as saying I believe that 2025 from a total closings perspective is going to be plus or minus 5%. And I've said I think it's going to be closer to plus or minus 2.5%. I'm still going to bet on that. I feel like we're still going to pull that off, and it seeing these backlog numbers makes that a little less affirmative, but I'm still going to keep my bet on that we're going to be within plus or minus 5% next year over this year, and I think it's still going to be a good year. I think the remodeling industry is going to do well this year. I know there's talk about the for rent, the commercial easing up and slowing up. I think 2025 is just going to kind of be a rebuilding, a resetting year. And in one of our other future upcoming podcasts is we're going to talk about the end of the first quarter, things that are happening, what you can do to utilize the second quarter to really gear up to take 2025 and make it a building year, a foundational year to prepare for an amazing 2026, which is what we're here at Amazing Mindsets are predicting and preparing for. So with that, we'll let you go. Hopefully you were able to get this all in on your one commute, or hopefully not, depending upon how you look at it, less than a half hour. We appreciate you. We appreciate all you subscribers. If you haven't subscribed, please do so. It helps push the podcast out to most people. Please feel free to reach out. What we try to do on this to be a little bit different than a lot of the other home building stuff is we don't want it to be too technical. We want it to be enjoyable. We want to talk about the nuts and bolts of the numbers in kind of like a real down-to-earth kind of way. And I definitely do have more of a sales numbers, operational numbers focus as opposed to more of a finance. This is definitely comes more from the operations side of the business. That's kind of where I come from. And, we want to get it out to more people because I think the home building industry is a big, big part of the American dream, the American economy, the American machine, and American jobs. And soon, I believe, even more American manufacturing. You can make the argument that it is. We're manufacturing houses on site. A lot of the materials do come from the United States that are made here. I think we're going to see more of that. So, we want to make this fun and something that people who maybe aren't finance folks like me, I've got a scientific calculator, not an HP. We hope you enjoyed it. Thank you for supporting the show. Thank you for listening. You guys have a wonderful, an amazing week, and we'll talk to you next week. Okay. First time ever, and we're all about transparency here. We're going to splice this one in because I just realized I forgot the one last thing that I said I would do. I promised that I would say, with all of that positives and negatives, how Wall Street treated Lennar. So Lennar reported on Friday morning, Friday the 21st, I believe it was, March. And so don't worry when this airs, when you listen to it, but this data is as of that weekend. So we looked at it over the weekend because we thought it would be really interesting to kind of share with you. So all that stuff that Lennar reported, and basically I believe Wall Street didn't get much glimmer of hope in those positive numbers that I shared with you. I think they focused all on the negative. And so Lennar's stock the one day was down over 4%. That's a huge, huge drop. And their stock over the last 6 months, as we talked about, the market was not happy with their last earnings report either. And so over the last 6 months, Lennar stock is down 33%. Okay. So I do have people asking me about the end of the world in the home building industry because of numbers like that are horrible. And, it's beaten the whole industry up. But over the 5 years, in the last 5 years, Lennar stock is up 210%. So you've got to look at the long game. If anything, in my opinion, this is time to buy Lennar stock. I'm not a licensed anything or whatever. This is just my personal thing. It's because I'm bullish on housing. I believe the housing industry, if you look at it over the long term, I believe that I would invest in home building right now because I think long term it's a great play. I think demographics speaking, there's nowhere for it to go but up. But it will have some downs in the meantime. So I'm not making any suggestions to anybody out there. I'm not a licensed financial anything. I'm bullish on housing in 2026 and beyond. I think we're flat in 25. But here's what also did. We talked about Toll and Hovnanian in those same windows of time. So KHOV was down 4% on Friday, and Toll was down only 1% on Friday. KHOV is down 51% in the last 6 months. Toll's down 31% in the last 6 months. But get this, Toll is up 390% in 5 years. KHOV is up 1,010% in 5 years. I think they've got a little room from an investment perspective to take a little plateau, a little dig back, and see where they go. They've got other fundamentals that they're working on, and they've come a long way though. KHOV was in a really tough spot a few years back, and they've really come a long way to get their business turned around. So my hat's off to them for everything and all the hard work the folks over at KHOV are doing. Now let's just round out. We'll do number 1, 3, 5, and 7 on the public list and on the closing list. D.R. Horton, 1 day down just under 2%, 6 month down 33, 5 year up 250. Pulte, 1 day down 2.5, 6 month down 28, 5 year up 318. Meritage Homes down 1.5% 1 day, 32% down in 6 months, up 258% in 5 years. Taylor Morrison, 1 day down 2%, 6 months down 15%, 5 year up 428. So you take a look at that and tell me what you think. But it's not surprising. And typically when one builder has a report like that, when the market pounces on one, they tend to push them all down. So there's where you have it. Hopefully we splice this in really well, and we'll leave the goodbye for the intro that's coming, or the outro. Have a great day. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.